Hey investors, what's going on here? We looked at over 100 companies in 10 different industries, and all we came up with was those you see on this screen. We're looking at 7 here, but guess what? Only 6 of them actually made the list because one fell off this week. Go ahead, guess who it was, and then take a dive in and let's find out. Hey investors, don't forget we've got a very rigorous set of standards that a company has to make to be on our list in the first place. If you like what we're doing here, go ahead and hit that like button and the subscribe. Hit the bell so you don't miss a single edition. And don't forget to tell your friends so they can join in the conversation. Now folks, before we dive in, I want to try something a little bit different this week. Let me know what you think about this. As the year moves on, of course, we progress and get another year's worth of data. Now, what I had been doing was just dropping off the first year's worth of data and then adding on the subsequent year's data. But I got to thinking maybe it would be interesting to look at all the years as they accumulate. So what I'm going to try this week is I'm going to show you the next year's data, 2020, that has been added to the data. We're going to keep the 2002, and we're going to look at how the companies fare both in the 17-year window that we've been looking at, and then what I'm going to call the extended window, which is the additional time. All right, because we're doing that, we're also not going to do side-by-side comparison on a couple of companies, but we're going to get through the whole list. There's only 7, and one of them is likely going to come off the list. So let's dive right in and get right to it with Polaris Industries. Ticker PLL. Their dividend yield is 2.5%, and that's on a valid price of $97.75 a share as of 3 May. You can see that they are not qualified for cash flow per share, earnings per share, but they are a Div 0 both for the extended time and for the 17 years. So this extended time means 18 years of increasing dividends per share with no flat years. Here's what that looks like on the long-term trend. You could see that they were kind of flat here, then they took off for a while, had a bad year in 16, and then they recovered and they're back at it again. But the dividends kept on coming up, not great slope, but still positive. And here is the year-to-year change for them. Next up is Disney. Now, Disney is the company that will probably come off the list. DIS, their yield is 1.3% on $133.36 a share. They're coming off the list because right here in 19, right now they're reporting a drop of 9 cents per share in the cash flow, which would make them 2 negative years and come off the list. Now this is still being finalized, so we'll wait till they determine those numbers are final before we make a final decision to take them off. Is that enough finals for everybody? All right, so they are not qualified on cash flow, earnings, or dividends right now. Here's what they look like on the long-term trend. You know, a good healthy climb, and then all of a sudden they're flattening out here. So we're going to see what happens with Disney there. And here's what that looks like on the year-to-year change. All right, changing industries now. We're in the publishing industry with Meredith Corp, MDP. Their yield is a very respectable 4.0% on $58.19. They are not qualified for cash flow or earnings per share, but they are qualified for dividends as a Div 0, both from the extended view and for the 17-year view. So right now that extended is 18 years, increasing dividends per share. Here's what that looks like on the long-term trend. Wow, that's a pretty steep climb on their cash flow. Earnings following, and the dividends keep on moving up. And here's what it looks like on the year-to-year change. Same industry, John Wiley Sons, JWA. Now their yield is 2.8, not as good as Meredith, but they're still above the benchmark of 2.6. And that's on a $46.88 per share threshold. They're not qualified for cash flow or earnings per share, but they are a Div 0, both in the extended and for the 17-year view. So again, 18 years of increasing dividends per share. Here's the long-term trend line for them. This isn't exactly a great upward slope on the cash flow or the earnings, but the dividends keep moving up. Not a great slope either, but it still qualifies. And there they are on the year-to-year change. New industry, advertising, Omnicom Group, OMC. Their yield is 3.3% on $80.55 a share. Now, interestingly enough, they're not qualified for their dividends, but they are qualified as a cash flow 1 and an earnings 1. All right, so cash flow 1 for the extended period and for the 17-year window. And here you can see they took their hit in 09 like a lot of people did for cash flow and earnings, which is why they're a CF1 and an E1. Here's their long-term trend. Nice steady upward progression. That slope is probably, if you took this line and laid it right on here, if they didn't have that hit, you'd probably still see just that same nice slope going up. And here is their year-to-year changes. Changing industries again. Now we're in chemical diversified air products, APD. You've probably seen their trucks with all the big canisters on them. 2.4%, just below the 2.6 threshold. And that's on $196.67. APD is qualified as a Div 0 both for the extended view and for the 17-year view. Here is their long-term trend. There's the dividends continuing to climb, always positive. And here's what that looks like on the year-to-year change. Same industry, chemical diversified, PPG Industries, ticker PPG. Their dividend yield is 1.6% on $117.62. They're qualified as a Div 0, so 18 years for the extended view, 17 years of increasing dividends per share, but at 1.6%, it's hard to get too excited about that. And here is what they look like on the long-term trend. And here is the year-to-year change. So in summary, you've got Polaris and Disney in the entertainment business, but Disney may very well come off because their cash flow hit. The real cooker here is Meredith in the publishing business. Can you believe that? But it's because they do a lot of online stuff too. And they do a lot of analysis as well as the publishing stuff. So 4.0% for their yield, and they are a Div 0, so that might be a good income play for some folks. You got John Wiley is also qualified, 2.8%, not great, and they're 0. If I had to choose between the two because they're in the same industry, I'd go with Meredith. Omnicom in the advertising group at 3.3, and they're qualified on cash flow and earnings. And then in the chemical diversified, you got Air Products and PPG. Neither one is much to get excited about. All right, I'd like to know what you think about this format. Do you want me to keep the extended view and the 17-year view? Or you want me to just go back to that 17-year view? And of course, when we get some good battles between a couple of leading companies, I'll approach it from that perspective. But the real question is, do you want me to keep adding those years for the extended view or just stay with the 17? Please leave your comments down below. I'd like to hear what you have to say. Don't forget to tell your friends about us. We will see you all next week.